Well, the budget is done. The day after the budget sometimes is equally eventful. Good morning. Hello and welcome. You're with us on a fresh new edition of Bazaar Morning Call. I'm Prashant Nair. With me, my colleagues Nigel and Lata is joining us as well. Guys, hi. Good morning.
Good morning, Prashant.
It's going to be an interesting day. Once again, not for just one reason, but at least two or three.
Oh, yes. Three big reasons.
Yeah.
I agree with you.
Let's just get the ball rolling straight off the bat. The big event, I think the new thing which the market is going to respond to this morning is the Fed decision. And I think it's a big one. And I'll tell you why. The 25 basis point perhaps is the only thing which was in line with expectations. The other stuff was kind of out of syllabus. And what do I mean by that? Jerome Powell, the Fed chair, after hiking by 25 basis point and kind of delivering a inline kind of statement broadly in the press conference, did not push back against the market rally. He did not push back against the loosening of financial conditions. And I think this was a big change as compared to the previous couple of meetings where he did that. Markets were expecting that he will say, you guys are rejoicing prematurely. This is still job not done, etc., etc. That did not happen. Point number one. Point number two, Powell mentioned, and I don't know who counted this, I picked this up in terms of the reporters from the Fed, disinflation 10 times in the press conference, right? So, and this is the first time he's seriously talking about the fact that maybe we are in the beginning of the stages of disinflation, which is kind of here to stay. The other thing which he did is he did not kind of argue against the market pricing. The Fed dots as against the market pricing is very different. Market pricing is suggesting that there perhaps will be one or two rate cuts later this year. He did not argue against that. When asked a question, he said, well, markets have their own perception and we will see. So I think this is what almost the market rallied after that. The price action, the 2% rally on the NASDAQ, etc., followed the press conference, and it kind of almost validated the market's perception that inflation and sort of interest rates are not going to be a problem through the bulk of 2023. The worst of it is perhaps behind us, not ahead of us. Okay, that's one. That's the new thing that I said. The Adani FPO cancellation is the other thing. The withdrawal of the FPO, the money will be, of course, refunded. And this is the one which is drawing a whole lot of opinion, right, out on social media, out everywhere else in terms of what is this going to do for stocks and for the broader market. I think we will find out. But I think one thing is clear, that this is, in a way, an acceptance of the reality of what's happened in the market, right? Just yesterday, the Adani Enterprises stock lost about 1,000 rupees in value. And the difference, the gulf between where the stock was issued in the FPO and where it is now is just too large, right? So in that sense, this is a very logical kind of a move which has come through. Just one more thing, for those who are wondering whether this issue is going to continue to fester, etc., we don't know. But I think what we know from previous instances is that the incremental impact of the news flow should come down. You know, you've had 2 days now where the Adani issue has resulted in market selling off in a very sharp way. Will it continue to have the same impact? I don't think so. I think, as newer and newer stuff, and you can be sure that we will continue to hear reporting on the story, the incremental aggregate impact on the market will continue to come off. So that's point number two. Just a quick bit on the market itself. Yesterday, of course, was a big swing, 600 points on the Nifty, 2,500 points on the Bank Nifty. The Nifty got to the 20-day moving average. That is how high the Nifty went, and then sold off almost exactly from there. The 20-day as of yesterday's close stands at 17,296, right? I mean, if you start to get a bit of an up and up move, 17,296 perhaps becomes a resistance. On the way down, yesterday's low is 17,353. That is, I think, to be defended. And then the 200 days also around there, 17,300. I mean, almost we got to those levels and then kind of bounced. This is a simple 200-day. Unlike the Nifty, the Bank Nifty did not make a fresh low. That is important and that is interesting as well. So on the way down, 39,419 is the kind of level which I think should hold, hopefully should hold. And on the way up for the Bank Nifty as well, actually the Bank Nifty kissed the 20-day yesterday and exactly from that level turned down. And that level is 41,992. So I think for both the Nifty and the Bank Nifty, the recent lows, it's slightly lower for the Nifty as compared to the Bank Nifty, and the 20-day on the upside become crucial to watch out for. But I mean, this week actually, Lata and Nigel, has been so interesting, so rich in terms of at least reporting and opinions, right?
Absolutely. Great to be a reporter. Yes. Now, let me give the other side of all the points that you mentioned.
Yeah.
Okay, two ways of looking at it. It's true that Powell mentioned disinflation 10 times or maybe as many a time as that. But he also said that there is need for more action. I mean, there is need for more evidence that inflation is down. There was a counter to his statement. And more importantly, in the statement itself, ongoing rate increases are needed. We see the need for ongoing. Now, this is not just Powell. This is the entire Fed, FOMC, telling you that ongoing rate increases are needed. I just looked at the CME Fed Watch. There are a reasonable number of people who are expecting one more rate hike. And then perhaps by the end of the year, the number of rate cuts are more than the number of rate hikes. But there is that. However, I take your point that ultimately what is the market's verdict? The market's verdict is that it's bullish. Okay, so we are seeing that green all over the screen, especially in the bond prices. Prices are higher, the yield is below 3.5. Now, likewise, let me come to the budget as well. Okay, for us as well, the budget is going to keep bond yields down. And therefore, there is definitely a positive for the bank Nifty. The other side, the negative Q, there's one from the Fed that there are more rate hikes. The other one is on the Adani FPO. We cannot be very sure that all the bad news is over. There is still the MSCI sword hanging over our head, whether the inclusion will be questioned. And now with, once you withdraw the offer, there could be a feeling that the pro-Hindenburg side has something to say because this side has bowed down. So there can be further backlashes. To be sure, there'll be short covering, and in any case, there aren't so many people who own the stock, so perhaps further short selling is tough. But nevertheless, there will be questions. I think in a bit you will be telling us how the Adani bonds have done. So how will he raise money? Indian banks will be afraid to take exposure. If they do, the market may, not like it. And more importantly, how do they raise money even outside? So that may put question marks, and therefore the backlash could continue. We don't know if the market perceives that growth is difficult. And the other negative is we have to remember that the budget has some casualties. While it's a great macro budget, and that's why the bond market was way more jubilant than the stock market, the casualties would be, is there continued pressure on insurance companies? And is there continued pressure on real estate companies? Because the capital gains tax, which could be set off by buying a luxury house, now you can buy only up to 10 crore. So houses above 10 crore could have a problem. There are those negatives we have to contend with.
Okay, all right. Before I get to markets, I have just one point on the Adani Enterprises stock. The technical factor out there is that some of those naked shorts, they could be forced to cover out. Point number one. The second factor, if that book, that subscription book had hedges, the trade would be you short in the futures and you hope for allotment in the cash. Now, they are still, in the FPO. Now, they're well in the money, but suddenly that short could become a naked short. So those are the two small points I want to make, whether the Adani Enterprises stock could see a bit of a short covering bounce today.
The conversations I had with dealers yesterday night after the announcement was that there could be a short covering
Absolutely.
bounce.
And these are the two big points on that, the naked shorts and the hedge positions, if any. Okay, let's get to market setup then. The SGX, if we're suggesting, we're likely to start off in the red with a cut of around 100 points. I like this actually, because otherwise the markets are flying away, then it becomes a bit of an issue. Now you're getting a dip. So at lower levels, could there be a case for a short covering bounce? Remember the FIs they bought after a while, they covered some shorts as well. The PCR has moved down to around 0.7. I mean, we've seen in the past, when the PCR moves to 0.65 to 0.7, we do brace for a bit of a bounce out there. And the dollar index is sub $101. Brent crude prices have cooled off close to around $3 overnight. So that as well is good. And the bulls, they're coming to fight at around 17,350 to around 17,400. So that's, the four factors that could play out in case we do have to see a short covering bounce. On the FI part, well, they bought yesterday. And that was, after selling for 7 straight sessions. And this is the largest buy number we have seen since November, November 11th itself. Institutions, as the FI and the DI number together, well, they bought close to 2,300 crores. And that's the best we've seen in the last 40 days. So both those two data points, they tick. The FIs in the FNO market, they covered 7,700 short positions. Though the overall short positioning is at around 81%. And after a couple of days of adding 20,000, 25,000 short contracts, they unwound some shorts. So there was a first hint of short covering after many, many days. And it appears on the Nifty Bank at lower levels, there was some short covering bounce. Because yesterday, the open interest out there was down close to around 10%. Let's see whether or not it has more legs on the short covering side. On the options data, though, 17,700, 17,800 call, they have been getting written very, very aggressively. At the highs of the day, the premium out there was around 100, 150 points odd. So the first level of resistance will come at around 17,800, 17,850. But otherwise, in terms of the overall setup, Well, you have support levels that should come up for you as well. And the recent lows on the Nifty and the Nifty Bank, both of them come up for you, and we have defended that mark. On the Nifty, 17,350 to 17,400. On the Nifty Bank, 39,400 to 39,500. So we've got a levels out there. You know, Prashant, that 17,950, there are two levels out there. The 20 and the 100 DMA, both of them coincide there. And that's why we saw a bit of a pullback. But the SGX Nifty, down 100 points. I think at some point of time, there's going to be a short covering bounce that will play out at lower levels today.
Okay. Well, important. Thanks a lot for those levels. Important to note, while you were speaking, ICICI Pru has announced that only 6% of their policies fall in the category of non-unit linked premiums over 5 lakh a year.
Yeah.
Now, in any case, those are retrospective. That will not be impacted. It is prospectively that kind of policies will not be available. So maybe their APE, annualized premium equivalent, could fall by 6%. Because that is the extent to which they had those premiums in the current year, in FY23. So it would be good if all the insurance companies put it on the record so that this blind selling on fear that there could be a lot of over 5 lakh premium guys will move out. But in any case, I just want to point out again that that's going to be a negative for the bond market. These guys who bought these guaranteed products were buying bonds because, you know, they have to give back a guarantee to the buyers, to the policy holders. So my sense is the bond market will have to take notice of this absence of insurance buying sometime later this year. Okay, with that, let's come back to equities. And the big equity call of the morning comes from Ridham Desai of Morgan Stanley. He says the sharp increases in capital spending in a year of global uncertainty, a credible fiscal consolidation, no change in capital gains tax regime, and lower than expected market borrowing augur well for stocks. This budget probably means that consensus earnings estimates may need to rise. Morgan Stanley remains 10% ahead of consensus EPS for the BSE Sensex. They are overweight on financials, discretionary consumption, and industrials, underweight on global-facing sectors and defensives, except technology.
Well, this is Mahesh Nandurkar of Jefferies, who says that the budget FY24 is a reiteration of the key tenets of the government. A 50 basis point fiscal consolidation for FY24. Proposed adjusted capex growth of 24% came at the cost of only 2% non-capex expenditure growth in a pre-election year. But these things can change during the course of the year, as has happened in FY23. FY23 capex, he points out, growth there was 8% against 14%, which was budgeted. Mahesh says ITC, L&T and capex plays and pipe companies should witness positive impact, while the budget may incrementally be negative for insurance companies and oil marketing companies.
And now we get to money market views on the rupee. Parul Mittalsana of Standard Chartered Bank says the dollar INR has seen upward pressure last week on account of equity FPI outflows of $2 billion, even as weak dollar limited the up move. She sees the dollar rupee trade in a range of 81.50 to 82.25 per dollar range next week on sustained dollar weakness after the FOMC guidance seen as somewhat dovish. The next event to watch out for is the Reserve Bank Monetary Policy Committee meeting next week, and Parul expects a 25 basis rate hike.
Okay, on the bonds, we've got Parul Mittalsana of Standard Chartered, who says that domestic yields saw downward pressure on positive sentiment from borrowing numbers coming in at the lower end of the market expectation at 15.4 trillion gross and 12.3 trillion net. Global yields have slipped post-FOMC, with guidance seen as data-dependent and somewhat dovish, even as 25 basis point rate hike decision was as expected. She sees the benchmark 10-year yield to trade in the range of between 7.15 to 7.3 this week, with a close watch on the MPC decision. She expects terminal 25 basis point rate hike to 6.5% from the Reserve Bank of India.